Hello traders and welcome back to my YouTube channel IPDATrader. Now in today's video I will be giving you an in-depth explanation on the concept of mitigation. Mitigation is a very important piece to the puzzle if you want to trade smart money concepts, so we're going to be diving deep into that concept today, so let's get started. Okay traders, we're back on the drawing board as we usually do, and we're going to be taking a look at mitigation, right? So the first question you may be asking yourselves at this point is, what is actually mitigation, right? What is mitigation? And to keep it short and sweet, mitigation is the act of smart money or central banks of closing negative positions out, right? And what do I mean by that? How would that translate into the charts? So let me actually go ahead and do that, right? Let's imagine we have a market that is consolidating, right? We're moving up and down, and all of a sudden you get a aggressive down move that leads into an aggressive up move then, right? So what is essentially happening here? Let's describe that first. What is happening here is the following. Smart money or central banks are selling very hard right here, right? They're putting a lot of money into these sales so they can then drive price lower for them to buy at a cheaper price to then resume the bullish move, right? So they're doing two things here. They're stopping people out, right, that have been buying below these lows. Plus, they're getting better prices for their positions, right? So what they actually need to do to achieve that is first sell very hard, then they get the better price, and then they buy very hard, right? And a good sign that you could potentially look for in order to identify if the banks were involved would be imbalances, right? If you see that there's plenty of imbalance within this up move, right, all the way up, that means that the up move was too aggressive and they probably didn't have enough time to close out the cells, right, the cells of this region, and that are going to need to return at some point so that they can close those sales, because at the moment, yes, they're making huge money with the buys, but the sales that they have right here, there might be some orders that still need to be closed before continuing. So now this is where mitigation actually comes into play, right? Because now you can justify to yourself a potential down move back into this region, right? You can say to yourself, okay, smart money sold here really hard, right? Now they bought over here, they have the better price, and now they're potentially returning to this region so that they can close out the sell orders that they needed to open here in order to drive price down so that they could get the better buy price. And yeah, we might be returning here so that they can have a chance of closing those positions out to then potentially continue higher, right? And if you combine that with imbalances, structure, confirmations, and that sort of stuff, that's where you get your high probability trades, right? If you say to yourself that, and you see, for example, that on your left side, while price is doing the retracement down, right, we have plenty of imbalance over here. We can actually talk about imbalances at this point because that's actually related to mitigation. So if you see that price is fulfilling imbalance, which is price inefficiencies, then yeah, that makes a lot of sense that smart money could have potentially sold very hard at this point to then buy very hard, and all they're doing is returning here to potentially continue on higher, right? So let's actually translate this region over here into candles, right? How would that look if you're looking at the charts in terms of candles? So we're going to be doing that. So that last sell, right, this sell move right here could potentially look like a huge bearish candle, just like this, right? You would have your bearish candle, and all of a sudden, right, you get a huge up move like that leads tons of imbalances, right? Maybe the next candle barely wicks down and continues pushing higher, and then and you can see it on the charts that you have imbalance all the way here, and that price really needs to return at some point, because all they did here was offer buy side, right? And the market needs to be balanced out. So at some point they're going to return here and they're going to be offering sell side, right? because that's how the market, whoops, let's actually imagine this is a red candle, because that's how the market actually moves, right? They're at some point in time, they're going to need to return here to fill all these inefficiencies in price, right? And they're going to be combining that move down with potential mitigations, right? And this is where actually mitigations comes into play. If you have a potential demand zone at this region, right, you can physically see how price may drive into that and retrace a bit, right? It's going to be rejecting that zone multiple times because that rejection of the zone signifies positions being closed. Sell positions that were in the negative right here at this point are being closed at this point, right? As they're returning down and they're hitting the block, they're closing those out so that they can continue pushing up and making money on the better buys that they got at this point in peace, right? Now they don't have a sell position that they need to hold with potential billions of dollars in drawdown. So yeah, that is technically mitigation. Mitigation is essentially that. It's when you're seeing price hitting a POI and you're physically seen on the candle, so it's getting rejected a bit, maybe a huge reaction, right? But then back up very quickly and then aggressively move down. So that would be mitigation. It's not complicated at all. All you need to understand is that mitigation is the act of the central banks closing out the negative positions, right? In order to continue in in a given direction. All they're doing is essentially closing the negative positions out, right? So that they can keep making money in peace in whatever direction they actually want to drive the price. So let's actually now take a look at the charts because I think this is pretty interesting, right? As you can see, I had this POI region marked at this point, and if we look here, we can see what I was actually explaining, right? We can see the move down where they sold very hard so that they could have a better buy price to then drive price up, right? You can see here how then price aggressively moves up. So now what they need to do, as I said before, is at some point in time, they're going to need to return here. And as you can see, I was watching this POI, and if we, for example, zoom in, you can see the rejections, right? One candle, whoops, one candle rejecting here, the other one here. That means that they're closing their position out, right? I'm not saying that price cannot go deeper, right? And potentially into deeper demands. As you can see, I also have another demand zone or order block marked at this region, right? So we never know how far they need to mitigate, but as a rule of thumb, you would always see most of the times at least a 50% mitigation, right? Because they are going to need some time to close all those positions out. So if we zoom into even lower time frames, right? Maybe even a 5 minute, we can actually see how price is hitting. As you can see, price engineered liquidity just above it, grabbed it on the way down, right? And now we're mitigating. Let me remove this. Now we're mitigating those orders and we're rejecting the zone, right? You can see those rejections, potential move to the other side, right? Even lower time frame, we can see how they're mitigating those orders out, and now they have potentially shifted again, right? So that they can continue making money on the overall direction, which is essentially, if we account this move as the origin, up, right? They may never even return here, right? We never know how far they're going to need to mitigate. So that's essentially that in terms of mitigations. There's really not much to it, right? You just need to monitor price, right? If we draw it out like this is your POI, right? Let me do it better. Let me remove this and we go to a cleaner zone right here, right? This potential up move into the up move, you would have your zone here and you would see the imbalances on the way up. You would wait for the retracement to say, and you say to yourself, okay, we're being efficient now, right? We're offering sell side on a price point where we only had buy side. So now that we're here, I have a reason to believe that there could be a potential up move, right? You now can watch the lower time frames. You would see how they're rejecting, boom, liquid. This is a very liquid area, right? Because they are closing positions out. You would actually see how they're closing them out, and you would see potential bullish moves away, right? And once you get your confirmations, right, you can say to yourself, okay, we may have potentially finished closing those positions out as we're starting to see buying pressure again. So I may want to try and get a position somewhere over here so that I can continue with the overall trend and with the central banks and make money. So yeah, that is it in terms of mitigation theory, right? There isn't much more to it. It's just the act of seeing how they're closing those negative positions out in those areas of interest, right? However, there are two different possibilities and scenarios within APY, right? And we're going to be discussing those, right? I'm pretty sure you might have come across the scenario where, and this is scenario number one, and this is called a very liquid POI, and this occurs when the POI is very liquid on itself, right? You would have potentially price moving up, and price hits the mitigation block and drops aggressively, right? It drops aggressively. It won't play around inside this region. It just drops very aggressively away, right? It will not give you a chance to enter, and that's okay. That's going to happen sometimes, right? Sometimes price isn't going to be giving you your perfect entry so that you can get in with them and make money selling in this case, right? So that's one of the scenarios where the POI itself, the region you're waiting on, is pretty liquid on itself, because they may have grabbed a lot of liquidity on the way up, so that they have enough fuel now to just hit the block and continue selling. There's no need to play around inside this region or distribute or accumulate or whatever you want to call it. They just hit the block and leave because they don't have any reasons to stay there any longer, right? And the second scenario, and the most common one, is actually a non-liquid POI, right? This is what happens most of the times. You will have a non-liquid POI, which means that price would be coming up, just like this. Price would be coming up, and because it's a non-liquid POI, they need to engineer the liquidity here inside this region so that they then can shift, right? So you would see price moving up and down, maybe creating some sort of fake resistance for retailers. They would maybe move away a bit. Retail will get into sells very hard. They will start selling, and all of a sudden you see that price comes very aggressively up, takes the high out, and then moves down, right? Because it was a non-liquid POI, and they needed to engineer the liquidity first so that they can then stop those people out and continue selling. So yeah, those are the two different scenarios of mitigation you can potentially get, right? It's all about watching how price behaves inside a POI, right? The more you do it, the better you're gonna get at it. The more time you spend watching how price is rejecting those areas, potentially breaking short-term structure, you are going to have more confidence in executing those positions with the tiny stop loss right below the lows in this case, and bigger targets, right? So yeah, that is pretty much it in terms of mitigation. I hope this video was valuable to you. If it was, please leave a like, subscribe, and comment below, and I will be happy to reply to you.